Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Buying real estate in Japan usually means tens of millions of yen, a cash purchase if you're overseas, and, as we covered last time, a bank account you might not even be able to open. There's a way into the same market that requires none of that. Fourth and final video in our banking, investing, and pension series. We've covered NISA, the pension refund trap, and non-resident banking. Today, how to invest in Japanese real estate without ever buying a building. For a lot of overseas investors, investing in Japanese real estate means picking a Tokyo condo, wiring the money, and collecting rent. That's one way to do it. But as we saw last video, direct ownership from abroad comes with real friction, mostly cash purchases, a stack of paperwork, and, per the video before that, you likely can't even open a normal Japanese bank account to manage it. So is there a way to get exposure to the same market, office towers, apartment buildings, logistics warehouses, without buying one yourself? Yes, the J-REIT, or Japanese Real Estate Investment Trust. It's a fund that owns a portfolio of real properties, and trades on the Tokyo Stock Exchange just like a regular stock. You're not buying a building. You're buying units in a company that already owns dozens of them, office towers, malls, warehouses, apartment blocks, and collects the rent for you. The fund handles every tenant negotiation, every renovation decision, every acquisition, and simply passes the income through to you as a unit holder each period. J-REITs get a major tax break in exchange for one rule: they must distribute over 90% of distributable profit to unit holders to avoid corporate income tax. That's why the payouts are so consistent. Right now, in mid-2026, the average J-REIT yield sits around 5.2%. That's a meaningful jump. Just over a year ago, in May 2025, the average was 4.44%. Yields have been climbing as unit prices have cooled relative to distributions. Direct rental property in Japan typically nets somewhere around 5% gross yield, depending on the property and location. So the raw yields land in a similar ballpark. Here's where it actually diverges. Every J-REIT currently listed trades under 400,000 yen. Is almost equal to $2 for 69 per unit, and plenty trade for just tens of thousands of yen. Compare that to direct ownership. A modest Tokyo condo example at 40 million yen is almost equal to $246,914, is a fairly typical entry point, and that's before a single yen of financing or fees. On top of the purchase price, expect a 5 to 10% deposit at contract signing, plus another 7 to 10% in brokerage, registration, and acquisition tax. Non-residents who do secure financing usually need 30 to 50% down, most just pay cash instead. A J-REIT trades on the exchange during market hours. You can buy on Monday and sell on Tuesday if you change your mind. Selling a physical property takes months: listing, negotiation, contracts, registration. There's no same-week exit. A professional asset management company handles every tenant, every repair, every lease renewal across the whole portfolio. As a unit holder, you do nothing. Direct ownership means you're the landlord, or, as we covered last time, you're paying a property management company to be the landlord for you, plus routing everything through them since your own banking access is limited. That's an ongoing monthly fee, on top of the purchase costs, for as long as you hold the property. Here's the part that surprises most people looking at this market for the first time. Foreign investors account for roughly 70% of all J-REIT trading value on the Tokyo Stock Exchange, a bigger foreign presence than in Japanese equities generally. That's not new. It's a decade-long climb, from 46% in 2013 to 71% at the 2022 peak, and it's held near that level since. And here's the twist that connects directly back to last video. You don't need a Japanese bank account, a residence card, or Japanese residency status to buy a J-REIT. Most international investors access the Tokyo Stock Exchange through their existing overseas brokerage. Think about that contrast. Opening a basic Japanese bank account as a non-resident is genuinely difficult. Buying a slice of dozens of Japanese buildings from your couch overseas is, by comparison, routine. If you do become a legal resident of Japan, J-REITs also qualify for NISA's growth investment quota. Up to 2,400,000 yen is almost equal to $14,815 a year, completely tax-free, the same account we covered in the first video of this series. It's not a free lunch. You don't control a specific building. Unit prices move with the stock market and can swing faster than physical property values, and you're exposed to whatever the fund manager decides to buy or sell. If interest rates rise sharply, J-REIT prices can fall even while the underlying real estate is performing fine, a risk direct owners don't face in the same way. If you want direct control of a specific address, to renovate it, live in it eventually, or pass it to family, direct ownership is still the only path, and you accept the higher entry cost and banking friction that come with it. If what you actually want is exposure to the Japanese real estate market itself, with liquidity and a low entry point, a J-REIT does that job with far less friction and far less capital tied up. Picture two investors, each with roughly the same amount of capital to put into Japanese real estate. One spends it all on a single condo, deals with cash purchase logistics, and waits months for any liquidity if plans change. The other splits it across several J-REITs in an afternoon, collects distributions quarterly, and could exit entirely by market close if needed, with no Japanese bank account required for either. Before you decide, check whether your existing broker offers Tokyo Stock Exchange access. Compare current J-REIT yields against a specific property's realistic net yield after fees and vacancy. Confirm the currency conversion costs on both sides, and be honest about whether you actually want to manage a physical building, or just want exposure to the market. That closes out this series. NISA eligibility for foreign residents, the pension lump sum trap on departure, the reality of non-resident banking, and now the real alternative to buying a building outright. All four come back to the same fact: Japan treats residents and non-residents very differently, and knowing which rules apply to you changes the numbers substantially. Whether you're relocating permanently, investing from afar, or just curious how the system actually works, that residency line is the single most useful thing to understand before you commit any money here. Not financial advice. J-REIT prices fluctuate and past yields don't guarantee future ones. Confirm details with a licensed advisor or your brokerage before investing. You don't need to buy a building to invest in Japanese real estate. For most overseas investors, the J-REIT is the easier door in. Quick recap: J-REIT yields around 5.2% today, units under 400,000 yen, foreign investors at roughly 70% of trading value, and no Japanese bank account required to buy in. That wraps up the banking, investing, and pensions series. Subscribe for more data-driven breakdowns of life and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.